Oh, boom. Oh, wait. Hello and welcome. My name is Robert Lyon. I'm here with Gino Nadarov. And today we're going to be talking about how to pay less in taxes, all things about taxes. Taxes. What is it? What's the saying? It's like the only thing that's for sure is death and taxes.
Yeah.
Or maybe change in taxes or something like that.
Change.
So I am not the tax guru. I don't know. I don't know enough about how to tax. You've blown my mind really recently about basically buying real estate, and apparently when you buy real estate, it's not a tax deduct. But if you make your houses really nice and you basically spend a ton of money to make it a great house, that's a tax write-off, which I think is crazy. But where do you
Yeah.
think we should start with taxes? What have you learned from the years of investing and such on how to pay less taxes?
Yeah, for sure. Taxes are interesting because they're the kind of thing that you have to be more educated on before you actually try to implement any of these strategies. But the main strategy is to obviously buy assets that make you money, but also depreciate and over time, which allows you to depreciate the cost of that asset. So your main goal is to, and when it comes to real estate, those assets depreciate and they appreciate. So it's like you get to write off the depreciation and get the appreciation with your taxes in 27.5 years, over the course of the tax allowable to the IRS. But
Yeah,
I think the fact that when you can buy a piece of land or a piece of property and you spend money to fix it up, right, to improve the quality of that property, you are now expensing on the property. So that means that the money that's being spent is now considered an expense.
yeah,
And with that expense, it allows you to write off all those expenses in your taxes because those are considered basically money that was being spent. You're no longer making money when you invest into that property. When you buy a piece of property, you're putting a down payment, or you're buying that piece of property, either whether your money or other people's money. That money is in the property. It's not like the money just disappears, right?
right.
So you cannot write off that money. But if you're spending money on the property, you're improving the bathroom, kitchen, living room, roofing, foundation. I mean, you name it, like A to Z.
Yeah,
Improving for a tenant, for example, to live there, or for yourself, you can write off all those expenses at the end of the year, and you can do that per property. As each property has work and each property gets written off. So let's say you're making let's say $500,000 a year, and you can expense, let's say, like $150,000 and let's say renovation. You can
yeah.
write off about $150,000 worth of expenses at the end of
For
the year
each property. Yeah, that's crazy.
for as many property as much as money you spent, right? So spending money is also good when it comes to assets that you can write off, right?
Yeah,
So it's good. It's also like government wants you to spend money. They don't want you to just save it. Like they don't want you to just sit on the money and save on it. They want you to spend it. But the best way to spend it, they reward those that spend it for things that basically that you can actually invest in. For example, like assets that appreciate but also depreciate. So
yeah,
those are the assets that they would reward people to do. Now, if you go buy a car and then that car depreciates, you would have to to write off that car. You would have to use it as a business expense.
yeah,
Everything has to be on the business. So whatever you do, forget the personal. It's all business.
yeah. And I guess I still don't get why spending your money to buy a house, like if you have an LLC and you put all your money in to buy the house, how is that not a loss or a business expense? I think you said it's because the money goes into is basically now still sitting in the property. So that's
Yeah,
why the
because
government's like,
because
no,
well, you own the property. The money never moved. The
right, right.
money just went from. If the money is bought by the business and invested and still owned by the business, the money never changed hands.
Yeah,
So it's not
that's
until
crazy.
if the money doesn't change hands, you don't get it right off. So it's
Yeah,
like the money has to change hands. Now, when you sell a property, you have to pay taxes. When you buy a property, you have to pay taxes. So at the end of the day, you're gonna pay taxes. But how can you save on taxes, right?
yeah,
You cannot avoid the piper. You cannot avoid Uncle Sam. Uncle Sam was always going to charge you his the bracket, whatever, wherever you fall into as far as your income. But you can always help mediate that. There's a lot of things, real estate is the best, right? But I mean,
Right.
you can invest in like equipment, you can invest in, cars that, that you maybe have to fix the car, right? If it's a business expense, you can fix the car. That's an
Right.
expense. But anything on the mileage you can write off, you can drive. Let's say the car is driving around, you spend money driving to all the properties, you can write
Yeah.
off the car. So yeah, you can get like one, two. I don't think there's a limit on how many cars you can get for the business. I mean, shit, if you have enough money, buy them all. Like, so that's what I'm doing. So I'm just buying as many cars as I can, because at the end of the year I can just write all that off if I bought it. But I'm not doing that. I'm actually leasing. If I wanted to buy the car, which I will, I'm going to be buying a car here real soon, and that car that I'm going to buy is going to be pretty expensive, but I don't care, because that's good, because I can write off the entire car if it's over 6,000 pounds the first year, and that
Yeah.
saves me like 200 grand on that car, and
Mhm.
that allows me to like use that for my tax returns for next year. So
Yeah.
it's like I have to almost buy a car every year just to keep up with my taxes.
Wow. I mean, so my thinking is like whenever we're making a lot of money, like towards the end of the year, we should just that's when we should do all the renovation. I guess it doesn't matter when you do it, right? But
It doesn't
buy a
matter.
bunch of houses during the year, and then like towards the second half of the year, spend a ton of money on the renovations so that you don't have to pay taxes on them and stuff like that, and then start
Yeah.
the year fresh again. So like you want to get all your renovations done though before the end of the year. I guess that's a good way to think about it, right?
I mean, yeah, technically, as far as I'm concerned, is as long as you have invoices and you are able to prove that the work is done, or the work
Yeah.
is being done, or you spent this much money, you can verify that, then you're good. So that then it
Right.
really comes down to like, well, if you ever get audited, do you have invoices? Can you prove that the work has been done, for example? But then, as far as I know, I've never seen an IRS agent walk into your house. So,
Right.
what I'm saying, but you never know. Maybe they will. Now that they're cracking down on these new businesses, opening up small businesses, they're trying to crack down on everybody. But essentially the goal is, you obviously, you're going to do some work, you spend some money, you get a receipt from your contractor, and you in that receipt, essentially, you can, if he has a business, you can file that this individual paid you. But
Yeah.
most contractors, as we know, they all want to get paid by cash, and they don't want to
Yeah.
deal with the taxes. So then you just, and this is where the whole idea of like, well, the government isn't getting any of that. So that's where they're coming out with this FedNow system to mediate any kind of cash transactions. But the way you would kind of like use that to your advantage while it's still around is to pay your contractors in cash, and
Yeah.
and then basically have them do the work, and then get a receipt for the work that they did.
Yeah.
Now if they go and say I'm going to be filing taxes, and I'm going to need the receipt just for that reason, he might say, well, oh, I might not want to give you my my information, because I don't want to get taxed on this money. So then you have
Right.
to like work it out with the contractors. And most general contractors that are licensed, they have no problem giving you their general contractor's license. They'll give you their information, so that way you can, or their EIN, for example, so you can file your taxes and say that this company paid is the one that did it for you.
Yeah. And then like if you put all your money into like, life saving or life insurance, if you put all your money into marketing, like these like is life insurance an expense, you think?
No, life insurance is not an expense, because life insurance is money being saved.
Right.
It's like a bank account. So the only expense that you really like, other than like real estate, any expense to the business, marketing is definitely an expense. Absolutely, I love
Yeah.
marketing. Marketing is all day. Like I market all day, and
Right.
as you know, like marketing expense for me is the one
That's
of
like
the
the
best
biggest write-off, right?
the best and biggest write off you can have, at
Yeah.
least liquid wise, where you don't have to have a hard asset in order to write it off.
Right. So basically, if you're making a ton of money, right, the things that people should be investing is like more marketing for your business, making your business like investing more like tools and things like that. If you need the write off, right? If you make a shitload of money, there's going to come a point like what is the tax in California? Isn't it some insane amount like for
Yeah,
an entrepreneur?
it's like
It's like
30, 40%, 40%
yeah, that's
taxes.
awful. That's why you got to keep
Yeah,
track of
so
this stuff because like
yeah,
it means
yeah.
like out of 100,000, like 30% gets taxed. That means you got to spend at least 30% on marketing, uh, business expenses, something. So otherwise, Uncle Sam is going to take that money and not do what we want with it. Whereas we could do more with that money. Basically, is what I'm trying to get at, right? That's like, if of course, I'm all about paying the police and paying for roads and teachers and such. but I can use that money more effective, I feel like, than the
Yeah.
government, if I'm gonna be
Well,
completely honest. You
yeah,
know what I'm saying?
absolutely.
So that's kind of
Absolutely.
why we're doing this whole
And if you're
thing.
not an
Oh no,
entrepreneur
the
and
internet fucking slowed down.
oh
And
yeah,
we're back.
if you're not an entrepreneur and you're working at a 9 to 5, or you have a career job or whatever, one way I mediated the taxes as far as like how much I pay out, because what happens is I end up getting a tax return if you're working at like a W-2. You would get a tax return every year because you're paying so much taxes and you're taking home less money. So I was
Yeah.
like, well, you know what? Why am I paying these guys taxes? Like, what have they done with me? They're taking my money, they're investing my money. I'd rather keep that 7,000, 8,000 every year that I get back, and I'll invest that, right?
Yeah.
So what I would do is I would just claim, you would just have more dependents, right? For example, let's say you have family or friends, or even your girlfriend could be a dependent, whatever it is, you
Mm.
can ask them, as long as they're willing to be a dependent, you can
Yeah.
file for the dependencies, right? You can file them as a dependent, and then you can save on taxes, even on your paycheck. You can go in there, you can change your dependencies. You can go from like 1 to like 10, and that it just depends on how many people are willing to claim that they're dependent on you, right? So you can use that as a method to kind of mediate your taxes while you're working.
Yeah.
When you're an entrepreneur, then your best asset will be marketing.
Yeah.
If you're spending money on,
How
like
do
I
you
say,
how do
go
you
ahead.
buy a car for your business? You basically just get your business name and you sign that on the dotted line when you go to the dealership. And it's like, instead
It's
of giving them your
person. It's
social, you give them your EIN.
Yes, but it's still personally guaranteed.
Oh, okay. Well, yeah, but like legally, how do you buy a business car for your business?
Well, you have to have, first of all, you have to have business credit,
Right.
and if you build business credit and you have a personal credit that is good, you will get approved for a car, and you'll be able to buy that car with the business instead of your personal.
Yeah.
And your business has to have established, been in business for at least 2 years, and they have money in the bank. So they want to
Cool.
see all that, and then usually they don't really check the money if it's someone like potentially, as long as your credit is good and you have a active business that has been around for more than 2 years, you should be good. It's not
Yeah.
that hard. They'll just buy it with the business instead of your personal name, and
Yeah.
essentially your goal is that you want to make sure that that
Exactly.
car doesn't have report on the personal side.
I'm back. Or no, I'm not. And we're back. Stupid internet.
I've
The
been on.
government's fucking listening, bro.
We've been online the entire time, so I don't know.
Oh, maybe it's just my computer then. But
Yeah.
yeah, so basically though, like if you paid cash though, right, out of your business for a vehicle and you put it on that could be an expense, right?
Yeah, if you buy if you buy the car cash, then you can use that as a expense, because the car, you can depreciate the car on the business side,
Yeah.
and then you can write off the entire car technically if it weighs more than 6,000 pounds. Now, if
Yeah.
the car is not, if it's like a daily, like a Prius, or like, I don't know, like a Tesla, like the Teslas are not that heavy,
Yeah.
especially a Model 3 or whatever. Unless you get like a Model X, you're not gonna be able to write it off. So you get yourself, Tesla, then you can probably write off the mileage. You can
Hmm.
probably write off the interest that you pay on the car.
Yeah.
But yeah, that's pretty much it. So that's kind of like one way. Another method, besides doing renovation on an existing property that you own, or a rental.
Hmm.
Yeah, last night I was looking at some other interesting topics. Actually, Grant Cardone talks about it pretty much, renting instead of buying the property for yourself. It's like your house should not be bought. The reason he
Oh
says
yeah.
that is because, I was like, why would he say that, right? Why would you not want to own the property you have? Well, the reason is because you can write off the all that lease that you spent. That's considered a business expense. So if you're doing business in the house in any way, shape, or form, and you're actually renting the property, if it's an $8 million property or a $5 million property, and your monthly payment, let's say, is 25,000 a month, you can
Yeah.
write off all that money.
Hmm.
That's the difference. So when you're renting, you can actually write off the expense because you're leasing it. You're basically, there's if there's any like taxes associated, or sales tax, or like any kind of interest associated to that, you can write that off. But in a property, usually is a lease agreement, and you can write the lease agreement off as a business expense because you're operating business from your home. For example, if you have an
Yeah.
office space, you can operate that, but you cannot own the asset. Yeah, if you own the asset, then you can only write off up to $1 million. You can't write off up to 8 million, for example, if the property is worth 8 million.
Yeah, I think you can only write off like the one room that you work in or whatever. It was some like square
Yes,
foot thing that you can do
but
to save on taxes.
if you're leasing, if you're leasing, you can write off the entire lease.
Oh, that's interesting. Yeah,
That's
so I
the
could write off
difference.
this whole area as
Yeah,
a
if you're
fucking
leasing a
tax write-off.
property, if you don't own the property, you
Mhm.
can write off the entire lease. But the thing is, yeah, you have to have, you have to have a property that you're leasing that's substantial enough. You have to have enough money to be making to do that. There's a reason why you'll do that. Otherwise, there's no reason why you'll rent if you're not making like a lot of money. I mean,
Yeah,
renting for like day-to-day people, like, it doesn't make sense for the people that are just trying to get into real estate, for example, and own their own home. Now, they may not want to own their own home, but that's better than not having a home at all, because you can get that appreciation, depreciation.
yeah,
You get to spend money on the house, and then and then you can write off the money on that expense. So having your own house initially is not a bad thing, but as you
yeah,
grow, as you make more money, owning property for yourself where you're living in may not be the ideal way, because you're making more money and you need to be able to write off more. So that's when you're like, okay, well, you know what, I'm done buying houses for myself.
yeah,
I'm only buying real estate property, and I'm just going to rent a sick house somewhere, and I'm just going to pay lease on that. And then what I get is I get the write off on that, because I get to save money on the taxes. So I'm not worried about paying this property down, because at that point I'm basically getting more money in taxes write off compared to what I do in getting as far as investing into the property. So basically every month that you pay into it, you're not getting as much write off than if you leased it.
yeah,
So that's really what he talks about. But that's to me, that's, it's more like, I would say like high player games, like the people that are playing in the high level, like you're making millions a year, then that's something that applies. But on a day to day, if you're just, if you're average Joe Schmo, you're not gonna want to lease or rent, because you're just throwing that money away. So
yeah. It'd be better if you own the property.
you're right. You're better off to be owning the property when you first start off, because of the fact that you want to be able to have those write offs. You want to be able
Yeah,
to you want to be able to put your money somewhere other than the bank. You know what
yeah,
I'm
and to
saying?
own
Like,
something. Yeah,
own something, and then that way you can leave something for your kids or family or whatever. So there's again, there's levels to it, and then you have to have where you have to know where you are, right? So it flips. So he talks about the FSR, which is like, your first deals are like, you first care about your income, then you care about your taxes, and then you stop spending. Don't spend so much money, and then finally he talks about investing. So if you haven't made enough money, don't worry about investing. If you haven't checked saved on taxes, don't worry about investing. And
yeah,
if you haven't lived a poor life, like you didn't spend money on everything you want, then don't worry about spending. You need to live that kind of like mindset where you're just spending money when you need to,
Mhm.
and you need to save money as much as possible on taxes by writing off investments that you've made, if you had any, or and basically if you're going to be leasing, writing off the lease, or
Mhm.
a car, for example. If you lease a car, you can write off that car if you're leasing it under the business.
Yeah,
You don't only have to own the car to write off the car. You can write off any lease. As long as you're leasing it, you can write off the lease.
yeah. For business expenses.
Business
Somebody on
expense.
Facebook asked, "Why does the weight matter?" And I think they're talking about the vehicles.
Yeah.
Is that I forgot about that rule. It's like you have to buy if you're buying a car on the vehicle on the what's it called for your business, does it have to weigh a certain amount and be a write off?
Yes,
Uh,
because of the it's structured under the IRS law, which is where the weight of the car has to be a certain 6,000 pounds or more. Otherwise, it's not considered a I guess you can call it an investment,
Weird.
or a piece of equipment that it's being used for business. So
Mm,
if it's that equipment, like if it's an equipment that's being used for business, and you want to write off the entire vehicle, like it's
yeah.
considered an equipment now. It's no longer like
Mhm.
just a vehicle, right? It's now an equipment, because most trucks or trailers or any kind of like construction equipment that you would buy weighs more than 6,000 pounds. you
Is
know,
it 6,000 pounds? That seems like a lot.
that's what
That's
it is.
crazy. Is
It
that
has
why you're buying the G wagon?
yeah, you got to get the high weight. Every car
Land
that's have
Rover, G wagon, heavy
like
ass fucking
Model
trucks.
X, G wagon,
Yeah,
and anything that you dislike, any car that's heavy, like Lambos, like any heavy like Lambo, like the Urus, like those cars you can write up. But like even the Porsche, You can write off, like a Porsche Cayenne, for example. But all the SUV vehicles, that's why you can write those off, because they're considered like more like a utility vehicle or
Yeah.
an equipment for the business. It's not like a Honda Civic or Maserati that you're driving around like, day to day, or like, whatever. It's like a BMW or Mercedes that you're just driving around. Those cars are not going to weigh 6,000 pounds most of the time. And
Yeah.
those cars are just, those you can write off the lease. But if you want to write off the whole car, the first year, it has to be 6,000 pounds. Now, there's another thing that I haven't mentioned, which is something we do with real estate. And if you're in the real estate game, through my mentorships that I've learned, and how you can, save on taxes, is almost like I would say like a secret of secrets. It's an idea that has been going around for a while, but not a lot of people understand it. If you're doing real estate, not only to buy for yourself, but for investments, you could buy a piece of property and you can have an engineering evaluation of that property and determine whether that property is, has certain aspects to the property that you can actually depreciate, and depreciation within the first year, meaning that the property can be cost segregated. So cost segregation is being able to buy a piece of property, use whatever you bought that property for. You can do a cost segregation analysis on the property, and based on that value of the property, you can write off. I believe it's the first year. You can write off a certain portion of up to like $100,000 to $200,000 or even more. I'm not sure the exact rules on that, but you can write off the entire value of that initial appreciation or cost segregation of that value of the property first year, because what happens is the property may need some work, may have some problems, there may be some issues, and you want to do a cost segregation of the property in order to be able to bring that property back to market value. And by doing that, you are able to write off a lot more the first year. Instead of waiting at the 27-year depreciation, you can write off like the first year you can do like 3 years or 5 years. You can just write off like the first 3 to 5 years of the property the first year, which is pretty substantial.
Yeah.
And it gives you a big chunk of write off the first year. And that's the power of cost segregation, and being able to do that on a piece of property. Obviously it costs more money. You have to get an engineer out there to do some some analysis and some verification of if there's any kind of, like, let's say there's leaks in the air, in the windows. Like, let's say if the house is too cold, that's a problem. Like thermal analysis, you have to determine whether a property is actually livable. If it's not livable, you can write that off.
Nice.
So the things like that is beneficial, especially if you're buying distressed properties. So that's the value of doing cost segregation on distressed properties. And you can do that if you're investing in real estate. Now, not everybody is savvy enough to do that, but if you're in the game, like me and you, that would be an awesome opportunity to take a piece of property that needs a lot of work, do a cost segregation on it, take that segregation analysis, take it to your CPA, write it off.
Right.
Boom, right? It's like
I'm saying, like, well, like what you do is like you buy a house and then you add a room, right? That's all a tax write-off, and then you can actually up the value and make more money on it. So that's a pretty cool little like loop right there, that pretty much people should be getting on. Makes sense.
I don't only add a room, but
you know what I'm saying.
Yeah, if I added a room, I would maybe increase the property by a little bit. I would better off adding a bathroom or a kitchen. You better off.
Yeah. But I mean, you would add cash flow. That's what I was thinking.
Exactly. Adding units, definitely.
Yeah.
Adding units is a one way. Buying an extension in a room or additional units, converting your garage, or building an extra junior or senior ADU in the back or the front of the house. Or being able to get a construction loan and build a whole new building if you don't have the money for it. But essentially, I'd rather put money into a real estate and that's cash flowing. And instead of even getting a loan, I would rather, if I have the money, I'll just put the money in the property and let that money work for me. Like you just said, it creates cash flow. So now the money is in the property, but I don't care about the money, because now I'm going to get, continuous property income from the entire life of that property. And what the value of that is, your income goes up, but also now you have a piece of property that you can save on taxes by writing off all those expenses you just did to build that piece of property, because it's an existing property. the power of doing a development work is not in development work on a property that you don't own when you first buy it. You already own the property. You own the land or you own a piece of property on that land, and you want to
Yeah.
do additional work on that property. That's the power of saving on taxes, is when you're able to do additional work or do development work on a piece of property that you already own. That's all right. That's all written off because you're spending money now. You're no longer you already own the property, so there's no there's no like down payment. There's none of that. You already own the property. You know, you might not be free and clear, but you own the property in the sense you have the deed and you have a mortgage. And now you can just go and start doing development work, and all that expense, like I spent $65,000 building an additional unit. That's all written off.
I wonder if you could just buy land and build a house and make it a write-off.
You can
I mean,
buy
why
land,
not?
and you should not. There's no problem with that.
That's crazy.
As long as you're using your own money. Now, if you take
Right,
a
right.
loan, if you take a loan and you're paying back interest, you can probably write off the interest. I don't know if you can write off all the expense on that property, but because you're taking a loan. But if you actually
Yeah.
spent money and you're paying money back, then you'd be able to write off on that loan what you spent, and then eventually, unless whatever you spent up to that point, you might not. Unless you pay the whole loan off, then obviously you can write off the whole loan and the interest on that loan. But you're better off spending cash, because when you spend cash, there's no more interest involved. There's no loans. It's just straight cash.
Right.
So you can write off 50, 60, 70, $80,000 in cash, hard cash, straight off your taxes.
Yeah, that's crazy.
Yeah.
Boom. And then have you ever heard of I don't know if your wife does this or you do this, but do you have a separate bank account just for paying taxes? That was one of my mentors always told me, like, get a couple bank accounts, right? One is just for taxes. So every time you get a fat check, you put a chunk of fucking change in that little bank account or whatever, and that's just for taxes. You have another one that's like just for life expenses and bills and shit like that. And then you have another one that's like your savings and your personal, right? But that's always something I was taught. I've never done it, so I'd be a hypocrite if I did. But do you think it's worth doing if you're making a lot of money?
Putting money in what, in taxes?
Just have a separate bank account just for taxes, so that you like don't spend it and don't touch it.
It's
just an idea.
I think it's a good idea for anyone that's just starting off. I think if you can't control yourself and you have no way of controlling your money, or you tend to be in a situation where you're constantly having to like figure out how you're going to pay for something. Separate your accounts. Separate your accounts and create that rule that you can't touch this money. And there's at the end of the year, it's always, or I would say middle of the year, end of the year, it's always annoying to have to pay for taxes. It's like, I got to pay for these taxes now. But the thing is, the money that you should be making, if you did your deals right from the beginning, you got nothing to worry about because you're cash flowing, right? So if you're not positive on your real estate, and you're not cash flowing on the real estate, and you're like breaking even, and you have to save your own hard-earned money to pay for taxes, definitely create a tax account, right? Definitely create a separate account. But if you're using the proceeds from the real estate to pay off the taxes and the mortgage, which is what you want, that's an ideal situation.
So you got to make sure all your deals are cash flowing enough to pay all
your cash. When they talk about, I'm cash flowing, like when I say I'm cash flowing $1,000 a month, obviously that's cash revenue. But there's expenses, right? There's expenses for like utilities if I'm covering, if I'm spending anything else on the property, if I'm paying for taxes, I have to cover that, right? So mortgage wise, I'm covered, but there's taxes as well. So you might be cash flowing, if you're lucky, like $200 to $400 a month on each property, right? Like I'm talking about pure clean cash. Now in LA, I was smart enough to 5x that or 3x that because I do development. So the way you do development is you have to have either access to money, which is what we teach in Credit Leverage X, or you have to be able to leverage an asset and access money against that asset. So whether it's a car or a house, you can leverage the money in your car. You can leverage your car money in your house, take that money, flip it back, do some development work, come back and pay that off with the proceeds from the additional work that you did. You just got to know how to move money.
You think there's any like tax write-offs that with credit cards that I don't know, or loans?
Interest.
I mean, like interest. What does that mean?
You can write off interest on credit cards.
So any interest that you pay the credit card companies is basically a write-off.
You can technically write it off, yeah.
Yeah, because I was wondering if like you could just like buy a bunch of charge cards or something at the end of the year and be like, oh, it was a loss, and then just use that money later. I don't know anything about that though.
If you use credit cards and you don't, and you can, like, if you don't pay, for example, like when I was going through the hard trip, I had to, I had a bunch of cards I had to pay, and I was like, well, I'm not going to pay these cards, so I had to claim. Not I was like, oh, I got to settle these accounts. I didn't do bankruptcy, but I did settlement. So
Yeah.
when you're in that situation, whatever you didn't pay, you got to
Yeah.
pay taxes on.
Oh yeah.
So all the money that I didn't pay, I basically like saved, right? The money that I didn't have to pay, or like even though maybe that money was lost, even though maybe someone screwed me over, even though that money was stuck in a real estate property, I still had to pay income taxes on the money that I didn't pay, which is
Yeah.
insane. But that's the way they get you no matter what. They tax
Right.
you whether you make money or you lose money.
Mhm.
They don't care. So why not take advantage of the fact that you can invest your money and use the asset to write off taxes? And at the same time, if they're going to come back and charge you taxes for every little thing you've done in your life just to be able to survive, you have every right to come back at them and tell them, hey, you know what? I'm not paying for this because I bought this. Or you know what? I spent $30,000-$40,000 on this property. Here's my receipt. Go look at my taxes. If you want to audit me, go ahead. I got all my paperwork in order. I don't care.
Yeah.
When you're coming from that position, don't be scared. The IRS don't scare me. Nobody scares anybody. It's like at the end of the day, it's all it comes down to is money. If they
Yeah.
want their money, they're gonna get paid. At the end of the day, I can show them I save money and I've spent a lot of money and I've paid them a lot of money. So you guys can do the same thing. All you need to do is structure yourself properly and be able to have the right write-offs every year. So that means real estate, great write-off. Buying an expensive car on the business side, great write-off.
Yeah.
Investing in marketing, perfect,
Yeah.
amazing write-off.
Mhm.
If you're doing any type of consulting or any kind of business transactions that involves you to have to spend your time or money with your clients, you can write that off, right? You can write off a lot of those expenses. Let's say if you had to go and do something with your partner, and you guys went and did some kind of traveling for the business, right? For example,
Mhm.
if you have some kind of consultation event, if you have an event where you're spending your time and you're gathering people together and you're talking about business,
Right.
anytime even if I'm sitting here having a dinner with you and we're having a gourmet meal and I'm talking about real estate, it's a
Yep.
write-off.
Right.
Anytime I go to the restroom and I check my phone, it's a write-off. You know what I'm saying? Like literally anything I do is a write-off, because at
Right.
the end of the
Right.
day, everything I do and everything I see and breathe is air, is in either business or money for me. So it's like if you're
Yeah.
living that kind of game, then, and I know you are, Robert, so everything you
Mhm.
do is a write-off. So it
Right.
doesn't matter what you do, as long
Yeah.
as you're working in the mindset that you're literally working 24 hours a day unless you're sleeping.
Yep.
And that's what I love to do. And I know Alex Hormozy is the same way. So at the end of the day, and I know you are too, we work day in and day night. We our day starts at like say 8 in the morning, 7 in the morning. We finish at like 12 at night, one in the
Yeah.
morning. Me, sometimes I'm up till 2. So it's like for me, I'm working all the time. So, and I love it. That's the difference.
Right.
So it's like when you love what you do, you're not working. So then you might as well write it all off.
Yeah. I'm just thinking about Robert Kiyosaki. He was saying some interesting shit about how debt and loans are not taxed, right? So that's how the rich people, what they do with their money, right? They basically loan it out, and then they don't have to pay. If they loan money to somebody and then they accrue interest, they don't have to pay taxes on it, because it's literally just like loaned to them. Then they make a little commission,
Oh,
but they don't have to pay taxes on it somehow.
I didn't even think about that. That's so smart.
Yeah, so that's what the rich of
So
the rich
whenever,
do,
so whenever
apparently.
you make money, bro, just lend me some money. I'll pay you some interest, and then we can
Yeah,
write each other off. It's like,
and
well,
you're
why not? Why not?
yeah,
Right?
right, yeah, because you're actually making
It's like
money on the money.
I can take that money, go invest it into real estate, which is not a write off. But then I go do some development work on it. I'll take that
Yep,
money, pay you back in interest, and you don't have to pay any taxes on the money you just gave me, right? So that's
exactly.
where right there I just broke that down for you, right? It's like
Yeah,
very simple, and I didn't even know about that. That's crazy. That's another opportunity. I'm glad you told me.
yeah,
So
it's kind of
now,
interesting.
being a private money lender, which I was, which I've got screwed into, before. So I would I'm no longer in the idea of like, I want to lend money out to people. But if I know who I'm lending the money to and I trust this individual wholeheartedly, I have no
Yeah.
problem giving my money to family and friends and just lending money out of my immediate circle, which is, my family. If it's out of my family, it's somebody you trust, you should definitely lend them money. Let them and let them
charge money on it. That's
charge
what the
money
banks
on it.
do. You know what I mean? That's probably why
And
there's no
charge them
tax
in
on
it,
it.
charge them in it. You can charge them the interest on that money, and that
Yeah.
money is no longer taxable.
Yeah, exactly, because it was out of your
That's
possession or whatever.
amazing, man.
Yeah, that's
Wow.
what I was trying to figure out exactly what he was talking about, but it just kind of clicked.
That's freaking fire, dude. I
Yeah.
just went to my brain. I'm like, whoa. But it's like, that's crazy. So, and I always want to become a private money lender one day, but like, when I become
You
my
gotta have
own
the right
private money,
people and the right opportunities, and
it's
I don't
also
know
security.
anybody I would
It's security.
invest in.
It's like
Yeah.
security. Like it comes down to security. I don't really want to go through, if I give somebody money and then I have to go through collections, I don't want to deal with that. Right. So I want to make sure that if I give my money, that whoever I'm giving my money to, I'm going to get my money back plus my interest or profits. And you do that with these capital funds. Some of these capital funds, they do that. They allow you to put money in there and you can use that as a write-off for yourself when you do your taxes. So it's a beautiful, and actually they do funds. They do like $50,000, $100,000 and do real estate funds. And you can use and you can get a return on that money, even though you didn't buy the property, you invested the money, right? So anytime you invest money in the stock market, same thing. You're able to write off all the money that you lost. So if you lose, let's say, like, right now crypto is killing it, right? If I decide to sell right now and then anything I've lost, I can just like write off. Right.
Yeah.
I can use that as right. And then later on buy it again at the low. Right.
Yeah.
And I wouldn't get taxed on any of the income unless I sell.
Yeah. The smart way to trade that I've learned is to trade under an LLC, because if you make a lot of money in the stocks, there's like a fast gains tax nowadays. That's like stupid. It's like a fat chunk. It was like 18% or something like that. But if you basically trade under a different name or your business, right? Your business is actually doing the trading. Then you use the profits, but you can use that as a write-off essentially. Like you buy your whatever office you're trading in, whatever computer you're trading on, whatever courses you bought to improve your trading skills is now a tax write-off. So that's how you have to do that for stocks and shit. I don't know about crypto though. I know that one guy, we got some guy who joined the program. He said he turned like 100,000 into 400,000 and he has to pay like 33% taxes. He actually has to pay the taxes before they'll give him his money, which is crazy.
So
that's pretty savage.
It's for me, it's like whenever I make money on stocks, like to me, it's like, well, I can sell the stocks when the stocks have gone up a certain value, right? Like they made enough money, then it's worth selling. Otherwise, why sell them, right? Unless you're worried about them coming down. But it's better to basically, if you make a profit, to basically collect the profit and then reinvest, right, the money that you have. That way you never have money in the deal other than what you initially invested, or maybe have no money in a deal. If you're able to get your money out, that's what I usually do. I'll make an investment. The property, the investment will go up. The stock will go up. I'll wait for that stock to go up a certain period, a certain amount, and then as long as I can get my initial investment out, the rest of it, I don't care about it, because what happens is I have no money in the deal. Exactly. I got no money in the deal, and whatever happens. And I'd rather own that stock than have cash. So I'd rather own that stock than have cash, because cash is trash. Cash flow is king, but cash is trash. So
I think that was powerful, man. Any other last tax tips, I think, before I wrap this up?
No, there's a lot more we can get into next time, but I think that basically sums it up for us today.
Boom, boom, boom. And we're back, hopefully. Yep. Any other tax tips before we kind of wrap it up, Gino?
No, I think we're good. I think this is a good first round of tax education and knowledge. I think there's a lot more that we can get into as we progress and get into the more details of tax structuring and how to be able to write off more throughout the year and keep track of all that. QuickBooks is a great software you can use. There's other software that allow you to write off the mileage, for example, that you're driving. Just take advantage of the fact that, if you can convert your existing car into a business, that's already a write-off. That's the first thing everybody should do. Everybody should be driving a business expense car.
Yeah. I guess. And then if you get one of those and you rent it out, it's pretty sick little investment
Yeah.
right there that
I
you did.
know exactly. Or if you even if you don't buy it, let's say you lease it, you can flip it and make money off of it. You're making money. It's just like Airbnb. Most people
Yeah.
like they don't buy the real estate Airbnb. They might go and they might lease the Airbnb or a property, and then they go and turn around and rent it out on Airbnb. They're just basically using an asset. They create cash flow. But obviously you don't get the depreciation. That's when you get into ownership, it's a lot more lucrative to use taxes to write off expenses.
Right. Exactly. All right. Well, I think that was powerful. I'll talk to you guys in the next one. We're going live every Wednesday. And yeah, this goes out to everybody watching who's in our program and everybody that should be in our program. Go to creditleveragex.com/funding, learn about it. If you have any questions, feel free to reach out to me or Gino, and I look forward to talking to you in the next one. Peace.